Captives are reshaping the way businesses approach insurance. But what makes them so effective? They operate under a powerful framework that balances control, protection, and financial efficiency. Imagine a captive structure as three distinct layers: the frequency layer, or self-funded layer, the severity layer, or self-funded and shared layer, and the reinsurance layer. Each of these layers fund claims and losses of different levels of severity, from minor to major and shared to catastrophic. In this example, we'll break down the total annual cost of a captive into the typical percentages you may find for each of these captives layers. First, the self-funded and shared layers make up about 60% of your total annual cost. The remaining 40% of your total annual cost goes to your reinsurance layer. You and your captive members will fund the 60% portion for your self-funded and shared layers. These are often referred to as an A fund and B fund, respectively. Typically, of this 60% portion, 75% will go to your self-funded layer, or A fund, and the remaining 25% will go to your shared layer, or B fund. Now, the remaining 40% of your total annual cost will be paid by you and your captive members as an insurance premium for your reinsurance layer. Now, let's talk about the purpose of each of these layers and when they come into effect. First, the self-funded layer, or A fund. This is the foundation of the captive structure. This layer is designed to handle smaller, predictable claims and losses for your business within your normal day-to-day risk profile. And because these dollars are set aside specifically for your business and your captive group, you gain greater visibility and control over how they're used. Plus, when losses are lower than expected, unused funds may remain available to the group over time, reinforcing long-term ownership and accountability. Above that sits the self-funded and shared layer, or B fund. This portion is pooled across all the members of the captive group to help absorb larger, less frequent claims and losses. So rather than one business carrying the full financial burden, the cost is shared, limiting the impact on any single member. In most cases, individual exposure is a small percentage of your overall premium, helping protect businesses from unexpected financial strain while still maintaining shared responsibility. Finally, there is the reinsurance layer. This layer is designed for severe catastrophic events, claims and losses that exceed the financial capacity of the captive itself. Here, traditional insurance and reinsurance markets step in, providing protection beyond the group's defined limits. This ensures that even in worst-case scenarios, coverage remains in place and financial risk is contained. Together, these layers offer the best of both worlds: ownership and control over predictable, manageable risks, and protection against severe, unpredictable events. From the outside, your insurance program still looks traditional: the same certificates of insurance, the same proof of coverage. But behind the scenes is a more strategic model designed to reward high-performing businesses. Explore whether a captive is the right fit for your business with the help of the Baldwin Group.